After 60, your financial life often shifts. You may be preparing for retirement, living on a fixed income, or simply wanting peace of mind that your credit remains strong. But did you know that your credit score still plays a major role in your financial security even at this stage of life? Whether it's qualifying for lower interest rates, refinancing a mortgage, or even getting approved for senior living options, your credit score matters. Many seniors assume that after retirement, their credit score doesn't matter anymore, but that's a dangerous myth. A strong score gives you flexibility, saves you money, and protects you from unnecessary financial stress. Let's uncover the top 10 secrets to raising your credit score after 60. Practical steps you can start applying today. One of the biggest secrets is understanding how payment history impacts your score. Payment history makes up about 35% of your credit score, the single largest factor. What does that mean for seniors? Every on-time payment counts as a positive signal to lenders, while even one late payment can significantly lower your score. Imagine paying all your bills on time for decades, then accidentally missing one medical bill or credit card statement. Your score can drop overnight. That's why automation is your best friend. Setting up automatic payments through your bank or directly with lenders ensures you never miss a due date. If you're worried about overdraft fees, you can schedule payments for the minimum amount due while still paying more manually when cash flow allows. Seniors who adopt AutoPay see a drastic reduction in negative marks and an improvement in credit reliability. Why does missing just one payment hurt so much? Because lenders see it as a sign of financial instability, even if you've been reliable for years. The algorithms that calculate your score don't consider your life context, they only see numbers. A late payment at 65 is treated the same as a late payment at 25. For seniors, this can feel unfair, but the solution is consistency. By maintaining an unbroken chain of on-time payments, you demonstrate to creditors that you're still financially dependable. Studies show that seniors who keep up with all payments, even small ones like utility bills or store cards, can see their scores climb by 20 to 50 points within a year. Another overlooked secret is credit utilization, the ratio of how much credit you use compared to how much you have available. Utilization accounts for roughly 30% of your score, making it the second most important factor. If your credit limit is $10,000 and you owe $3,000, your utilization is 30%, which is considered average. But lenders prefer you keep that number below 10% if possible. Seniors often rely on credit cards for flexibility, especially when managing healthcare costs or emergencies, but carrying high balances sends a red flag. Reducing your utilization, even without paying off debt entirely, can quickly boost your score. For example, paying down just $500 on a $3,000 balance can improve your ratio enough to increase your score in the next reporting cycle. How can seniors manage utilization without feeling strapped? One way is to spread expenses across multiple cards rather than charging everything to one. Another is to request a credit limit increase, but here's where wisdom comes in. You're not asking for more credit to spend recklessly, you're simply raising your available limit to improve your ratio. If you have $5,000 in debt across two cards with $10,000 total limit, your utilization is 50%. If your issuer approves a limit increase to $15,000, suddenly your utilization drops to 33%, even without paying down a penny. This small shift can translate into a noticeable score improvement. Lenders like to see available credit you're not using. It signals responsibility, not risk. Many seniors wonder, doesn't closing old accounts simplify life and reduce risk? While it might feel practical, closing accounts can actually harm your score. Your credit history length makes up about 15% of your score, and older accounts add weight. If you close the credit card you opened in 1985, you erase decades of positive history. That history demonstrates reliability and stability to lenders. Even if you don't actively use those older accounts, keeping them open with zero balance helps your score stay higher. Seniors should instead focus on maintaining accounts with long, positive histories. If you're worried about fraud or inactivity, you can use those cards once or twice a year for small purchases, like a tank of gas or a grocery run, and then pay them off right away. This keeps the account active, protects your history, and prevents score damage. Let's also address medical debt, which disproportionately impacts seniors. Medical bills are one of the top causes of credit score damage after 60. Even though new credit reporting rules reduce the impact of medical debt, unpaid balances can still hurt. The secret is communication. Never ignore a medical bill. If insurance delays or coverage issues leave you with a large balance, contact the provider immediately and ask for a payment plan. Most healthcare providers would rather accept small monthly payments than send your account to collections. Once a bill reaches collections, your score can plummet by over 100 points, regardless of your age. By staying proactive and negotiating, you protect both your health and your credit. For seniors living on fixed incomes, credit repair might sound intimidating, but the truth is small. Consistent actions make the biggest difference. Paying on time, keeping balances low, preserving account history, and managing medical bills. These are the first 4 secrets to raising your score after 60. In the next section, we'll dive deeper into additional strategies, like disputing errors on your credit report, balancing different types of credit, and leveraging tools like secured cards or authorized user accounts to boost your numbers. Remember, building credit after 60 isn't about chasing perfection. It's about creating financial peace of mind so you can enjoy your retirement years with confidence. Another powerful secret to raising your credit score after 60 is learning how to spot and dispute errors on your credit report. Believe it or not, studies show that 1 in 5 credit reports contains a mistake significant enough to hurt a consumer's score. For seniors, these errors can be especially damaging because they often go unnoticed for years. Maybe a hospital mistakenly billed you for a procedure you never received, or a credit card company reported a payment as late when it was actually on time. These small errors add up and drag your score down. The good news is that the Fair Credit Reporting Act gives you the right to review your report and challenge anything that doesn't look correct. Seniors who take the time to review their reports annually often discover inaccuracies that, once corrected, give their score an immediate lift. You can request free copies of your report from all 3 major bureaus once a year at annualcreditreport.com. Look for late payments you know were made on time, accounts that don't belong to you, or balances that appear higher than they really are. When you file a dispute, the credit bureau has 30 days to investigate and correct it. Many seniors report seeing improvements of 20 to 80 points simply from removing wrong information. Why do these errors matter so much? Because your credit score algorithm doesn't know whether the late payment was your fault or the bank's, it just records it as negative. If you don't challenge it, lenders assume it's true. For seniors, this can make borrowing more expensive at a time when money needs to stretch further. That's why being proactive and vigilant pays off. Even if you're not planning to take out a loan right now, cleaning up your credit report gives you flexibility for the future. Another overlooked factor in your score is credit mix, which makes up about 10% of the calculation. Lenders want to see that you can responsibly manage different types of credit, such as revolving credit, like credit cards, and installment loans, like mortgages, car loans, or personal loans. For seniors, this can be tricky, because by the time you're in your 60s, you may have paid off your mortgage or car loan. While being debt-free is an incredible accomplishment, having no installment credit at all can make your profile appear less active. One simple solution is to consider a small installment loan or a secured personal loan, not to create debt but to diversify your credit profile. For example, some seniors take out a small credit builder loan from a local credit union, where the borrowed amount is locked in a savings account and repaid over 12 months. You never really spend the money, but the payments are reported as installment activity, boosting your credit mix and score over time. For those who don't want another loan, another strategy is to use a secured credit card. These cards require a refundable deposit, say $200 or $500, which becomes your credit limit. You use the card for small, manageable purchases and pay it off in full each month. This activity gets reported just like a traditional credit card, but without the risk of overspending. Many seniors find secured cards a safe way to demonstrate ongoing credit activity, especially if their past credit challenges have made it difficult to qualify for traditional cards. Within 6 to 12 months of responsible use, many people see meaningful increases in their scores. Some seniors also benefit from becoming an authorized user on a trusted family member's credit card. Let's say your adult child has a credit card with a long history, low utilization, and consistent on-time payments. If they add you as an authorized user, that positive history can transfer onto your report, strengthening your score. You don't even have to use the card for this strategy to work. The key is piggybacking on their responsible behavior. Of course, this requires trust and good communication, since misuse by either party can create financial tension. But for families who work well together, it can be a powerful way to boost credit quickly. Another secret many seniors overlook is the importance of keeping inquiries under control. Every time you apply for new credit, a hard inquiry appears on your report. While 1 or 2 inquiries won't do much damage, several in a short period can lower your score by 5 to 10 points each. Lenders may interpret frequent inquiries as a sign of financial stress, even if you're simply shopping around for the best rate. For seniors who may be exploring refinancing, consolidating debt, or opening a new line of credit, it's crucial to pace out applications. The solution is to be strategic. Only apply for credit you truly need, and when shopping for loans, try to keep applications within a 14 to 45-day window, depending on the scoring model. That way, multiple inquiries for the same type of loan are often treated as a single inquiry. This protects your score while still allowing you to compare offers. Let's also talk about debt consolidation, which can be a smart tool when used correctly. Some seniors carry multiple credit cards with balances spread across them, often with high interest rates. Managing all those payments can feel overwhelming and increase the risk of missing one. Consolidating those debts into a single loan with a lower interest rate not only simplifies payments but can also improve your credit utilization ratio by moving revolving debt into installment debt. Since installment loans don't weigh as heavily in the utilization formula, your overall credit profile may look healthier. However, the key is discipline. Consolidation only helps if you stop adding new debt to the credit cards you just paid off. For seniors, this strategy works best when paired with a strict budget to prevent slipping back into old patterns. Seniors should also be aware of the role of rental and utility payments in building credit. Traditionally, these payments didn't count toward your score, but now, some services allow you to report them to the credit bureaus. If you're consistently paying rent, utilities, or even phone bills on time, you can use tools like Experian Boost to have those positive records included in your file. This is especially useful if you have limited credit history or few active accounts, which is common after 60. Adding these data points can give your score a meaningful boost with no added debt. Raising your credit score after 60 isn't about taking risks, it's about protecting your financial stability. By disputing errors, diversifying credit types, using secured cards wisely, keeping inquiries low, and leveraging positive payment data, seniors can build resilience into their financial profile. These are the next set of secrets that ensure your credit works for you, not against you. In the following part, we'll explore how to manage debt responsibly in retirement, the best ways to handle collections, and how lifestyle choices like downsizing or travel can unexpectedly affect your score. Remember, small, consistent actions lead to lasting financial health, no matter your age. One of the biggest concerns seniors face when working on their credit score is how to manage debt responsibly during retirement. Debt isn't inherently bad, but the type of debt you carry and how you handle it makes all the difference. Credit scoring models look closely at whether you're making steady progress in reducing balances and if your debt-to-income ratio remains reasonable. For retirees, income often shifts from paychecks to pensions, Social Security, or retirement accounts, so every dollar matters more. Carrying large amounts of high-interest debt, like credit cards, can quickly eat into fixed income and create unnecessary financial stress. The secret is prioritization. Not all debts are equal. Focus on paying down the highest interest accounts first, usually credit cards, while maintaining minimum payments on others. This not only improves your financial stability but also helps your credit score by steadily reducing utilization. Seniors who systematically lower high-interest balances often see their scores climb in tandem with their reduced financial burden. Debt consolidation, which we touched on earlier, can also be a lifesaver when managed wisely. Imagine juggling 5 credit cards with different due dates, all at interest rates above 18%. A personal loan or balance transfer card with a lower interest rate can simplify everything into one predictable payment. For seniors, this is not just about convenience, it's about reducing the risk of missing payments. Missed payments are devastating for credit scores, while consistent repayment steadily builds them. However, the secret is not treating consolidation as free space to rack up new charges. Once balances are rolled over, cut back or even freeze spending on old accounts until they're fully paid off. Otherwise, you risk doubling your debt load, which harms both finances and credit. But what if you already have accounts in collections? This is where many seniors feel discouraged, but the truth is collections don't have to permanently damage your credit. The first step is verification. Debt collectors must prove the debt is valid, so always request a validation notice. If the debt is legitimate, the next step is negotiation. Many collection agencies are willing to settle for less than the full amount, and in some cases, you can request a pay-for-delete agreement, where they remove the collection record after payment. Even if deletion isn't possible, paying off a collection still improves your score compared to leaving it unresolved, especially with newer scoring models that weigh paid collections less harshly. Seniors often find relief when they see their scores recover after resolving old debts. It's a clear example of how taking action restores financial control. Sometimes seniors are targeted by aggressive collectors who hope fear will lead to fast payments. The secret here is knowing your rights. Collectors can't harass you, call at unreasonable hours, or threaten actions they cannot legally take. Understanding the Fair Debt Collection Practices Act empowers you to handle these situations calmly and with confidence. Protecting your mental health is just as important as protecting your financial health, and reducing stress around collections can make the credit repair process smoother. Now let's explore how lifestyle choices after 60 can unexpectedly affect your credit. Downsizing, for example, is common among retirees. Selling a larger home and moving into a smaller one or renting can improve your monthly cash flow, but it may also affect your credit profile. Paying off a mortgage early might reduce your installment account activity, which could cause a small dip in your score. While that might sound alarming, the long-term benefit of freeing up income often outweighs the temporary dip. The key is to stay active with other accounts, like a low-balance credit card, so your credit report still shows ongoing responsible use. Travel is another area where credit intersects with lifestyle. Many seniors use credit cards to earn rewards and points for trips, but charging large expenses without a plan to pay them down quickly can spike utilization rates and hurt your score. The trick is timing. If you book a $3,000 vacation on your credit card, try to pay off as much as possible before the statement closes, so the high balance doesn't get reported to the bureaus. Even if you pay it off in full right after, the reported balance could temporarily drag down your score. Planning payments around reporting dates ensures your adventures don't come with hidden credit costs. Healthcare is another lifestyle factor that ties directly into credit. Seniors face higher medical expenses, and unexpected bills can easily land on credit reports if not addressed promptly. The secret is proactivity. Always confirm insurance claims, track bills carefully, and set up manageable payment plans before accounts are overdue. Some hospitals even have financial assistance programs for seniors that reduce or forgive bills, preventing them from ever reaching collections. Protecting your health is the priority, but protecting your credit at the same time creates a safety net for the future. Another hidden lifestyle factor is co-signing. Many seniors want to help children or grandchildren by co-signing loans. While this comes from a generous place, it can put your credit at risk. If the primary borrower misses payments, your credit suffers too. The secret is to think carefully before co-signing and to set clear agreements with family members. Sometimes, offering other types of support is safer for your long-term financial health. For seniors, maintaining a strong credit score isn't about chasing numbers, it's about keeping doors open. Whether you're downsizing, traveling, paying off medical bills, or helping family, your credit score acts as a reflection of financial responsibility. Every decision, big or small, ripples through your credit history. By understanding how lifestyle choices intersect with credit mechanics, you can make informed decisions that protect both your independence and your financial legacy. As we move into the next part, we'll dive deeper into protecting yourself from identity theft, understanding how credit monitoring tools can give seniors peace of mind, and the role of budgeting in keeping credit healthy. These final secrets tie everything together, ensuring that your credit score continues to strengthen and support your financial goals well beyond age 60. One of the most important secrets to raising and protecting your credit score after 60 is guarding yourself against identity theft. Seniors are unfortunately prime targets for scammers because criminals assume they have good credit histories, established accounts, and in some cases, less familiarity with modern digital security. An identity thief who gains access to your social security number or credit card information can open fraudulent accounts in your name, run up charges, and leave you with the damage. The frightening part is that this activity can remain hidden for months until you notice unusual statements or see a sharp drop in your credit score. The good news is that seniors can protect themselves by freezing their credit. A credit freeze blocks new lenders from opening accounts in your name without your permission. You can still use your existing accounts normally, but no new lines of credit can be issued unless you temporarily lift the freeze. This is one of the strongest defenses against fraud and is free to implement with all 3 major credit bureaus. Monitoring your credit regularly is another vital step. Many seniors assume that once their finances are stable, they don't need to check their credit anymore, but ongoing vigilance pays off. Credit monitoring tools can alert you instantly if there's a new inquiry, a new account opened, or a sudden balance increase. This allows you to act quickly before small issues spiral into big ones. Some banks and credit card companies offer free credit monitoring as part of their services, while independent tools can provide more detailed alerts. For seniors, these tools offer peace of mind, reducing the stress of wondering whether something is happening behind the scenes. Instead of being surprised by a drop in your score, you're always in the know. But monitoring is only half the equation. You also need strong daily habits to keep your information safe. Shredding old documents, never sharing personal information over the phone with unsolicited callers, and using strong, unique passwords online are simple but powerful protections. Seniors who make these practices routine are far less likely to deal with the fallout of identity theft. Remember, it's much easier to prevent fraud than to fix it after it happens. Beyond protection, budgeting plays a central role in raising your credit score after 60.
Why?
Because your ability to pay on time and keep balances low is directly tied to how well you manage your income and expenses. For retirees, every dollar has a purpose, and without a plan, it's easy to slip into using credit cards for everyday living expenses. Once balances grow, it becomes harder to pay them off, which hurts utilization and lowers your score. A practical budget doesn't have to be complicated. Start by listing all sources of income: Social Security, pensions, retirement account withdrawals, part-time work. Then track your fixed expenses like housing, insurance, and medical costs. What remains can be allocated for discretionary spending, savings, and debt reduction. Seniors who clearly see where their money is going are better able to prevent overspending and keep their credit under control. Another budgeting secret is building a small emergency fund. Even after 60, unexpected expenses arise: car repairs, medical bills, or helping family members. Without a cushion, many seniors turn to credit cards, which can lead to high-interest debt and increased utilization. By setting aside even a few $100s in a savings account, you reduce the need to borrow when surprises hit. This not only protects your credit, but also reduces stress. Having cash reserves gives you freedom and flexibility, while relying solely on credit creates dependency. Technology can be a powerful ally in budgeting. There are many free apps that link to your accounts and categorize spending automatically. For seniors who feel comfortable using smartphones or computers, these tools make it easy to spot patterns and identify areas where you can cut back. Even something as simple as noticing how much you spend on dining out or subscriptions can free up money to pay down debt or build savings. And every time you pay off a little more debt, you're directly improving your credit score. Another hidden factor in budgeting and credit is managing retirement account withdrawals strategically. Taking out too much too quickly can reduce your long-term financial stability, while taking out too little may leave you leaning on credit cards. Coordinating withdrawals with your budget ensures you meet your needs without creating unnecessary debt. Some seniors also work with financial advisors to develop withdrawal strategies that balance tax efficiency with credit health. Even if you don't hire a professional, keeping withdrawals aligned with your budget helps you live comfortably without risking your credit profile. For seniors who want an extra layer of protection, setting up alerts through your bank or credit card company can be very effective. You can choose to receive text or email notifications whenever a charge is made over a certain amount, whenever your balance exceeds a threshold, or whenever a payment is due. These alerts act as both fraud protection and budgeting reminders. If you see a charge you don't recognize, you can act immediately. If you get a payment reminder, you can avoid late fees and negative marks. Over time, these little safeguards create a stable credit picture that lenders reward. Peace of mind is the ultimate goal in retirement, and credit stability is a big part of that. By combining identity theft protection with consistent credit monitoring and a clear budget, seniors can ensure their credit score rises steadily instead of fluctuating wildly. These habits not only improve the score but also reduce financial anxiety, giving you more freedom to focus on enjoying your retirement. In the final part, we'll bring everything together by looking at how to set long-term credit goals after 60, how to use credit to save money rather than lose it, and how to leave behind a strong financial legacy for your family. These last secrets are about moving beyond short-term fixes and creating lasting financial confidence that supports you for years to come. As you work to raise your credit score after 60, the final secret is shifting your mindset from short-term fixes to long-term financial confidence. A healthy credit score is not just a number. It's a tool that can help you save money, lower stress, and even leave a stronger financial foundation for your loved ones. Seniors who actively manage their credit often find they have more options, whether it's refinancing at a better rate, qualifying for lower insurance premiums, or simply knowing they can access credit in an emergency without high costs. Building credit after 60 is not about chasing perfection. It's about creating stability and ensuring your score continues to work for you, not against you. One of the most effective long-term strategies is setting realistic credit goals. Ask yourself what you want your credit score to do for you. Maybe you'd like to refinance your mortgage to reduce monthly payments, or maybe you want to downsize and rent, which still requires a credit check. Perhaps you want to keep credit available for emergencies while living primarily on savings. Whatever your personal goals, setting a target score, such as moving from 650 to 720, gives you a clear benchmark to work toward. Seniors who set specific credit goals often feel more motivated and focused, treating credit improvement like any other retirement project. Another long-term secret is using your credit to save money rather than lose it. A higher credit score means lower interest rates, and even a small improvement can lead to big savings. For example, raising your score from 680 to 740 could mean thousands saved over the life of a car loan or mortgage. Even if you don't plan on taking out large loans, your credit score can influence things like insurance premiums, utility deposits, and even cell phone plans. By raising your score, you reduce these hidden costs, freeing up more of your income for what matters most in retirement. It's not just about borrowing, it's about protecting your wallet every month. Seniors should also think about how credit choices now affect their financial legacy. If you hope to leave behind a home, investments, or savings for your family, avoiding unnecessary interest payments and penalties ensures more of your money goes where you want it to. Carrying high-interest credit card debt not only damages your score but also reduces the wealth you can pass on. By managing credit wisely, you protect your estate from being diminished by fees and debt collectors. For many seniors, this perspective is motivating. Good credit isn't just about today's peace of mind, it's about securing tomorrow's inheritance. Another long-term strategy is continuing to build positive habits, even if your score is already strong. Keep paying bills on time, maintaining low balances, and checking reports for errors. Think of it like maintaining your health. Once you've built good habits, you keep them going to preserve your strength. The same applies to credit. Seniors who view credit care as ongoing maintenance rather than a one-time project are more likely to sustain their scores into their 70s, 80s, and beyond. Credit counseling can also be an invaluable resource for seniors who feel overwhelmed. Non-profit credit counseling agencies can help create debt management plans, negotiate lower interest rates, and provide personalized guidance. Working with professionals can take the pressure off and ensure you're making the best choices for your unique situation. Many seniors discover that credit counseling not only improves their score but also boosts their confidence in handling money. Having an ally in your corner makes the journey less stressful. One more secret is the power of patience. Credit scores don't transform overnight. While some quick fixes, like disputing an error, can deliver immediate improvements, most progress comes gradually. Every month of on-time payments, every reduction in debt, every positive account reported adds up. Seniors who stay consistent often see their scores rise steadily, creating lasting financial strength. Patience is especially important if your score took a hit from past challenges. Don't let frustration derail your progress. Remember that credit scoring models reward consistency over time, and your score can recover no matter your age. Finally, it's important to celebrate progress. Seniors sometimes underestimate the value of small wins. Maybe your score rose 20 points, or maybe you paid off a lingering credit card balance. These milestones matter because they reflect your effort and discipline. Each step strengthens your financial future. Recognizing and celebrating these improvements helps you stay motivated, turning credit repair from a chore into an empowering journey. When you bring all 10 secrets together, paying on time, managing utilization, keeping old accounts open, handling medical bills, disputing errors, diversifying credit, controlling inquiries, consolidating wisely, protecting against identity theft, budgeting carefully, and focusing on long-term goals, you build not just a higher score but a stronger financial life. These steps work in harmony to protect your stability, give you options, and preserve your wealth for the future. Raising your credit score after 60 is entirely possible, and the benefits extend far beyond numbers. It's about peace of mind, independence, and legacy. With consistent action, smart planning, and the secrets we've explored together, you can turn your credit score into a powerful ally in your retirement years. Stay focused, stay patient, and remember that every positive choice you make brings you closer to financial freedom. And if you found these secrets helpful, consider sharing them with other seniors who want to strengthen their financial foundation. The journey is always easier when you know you're not walking it alone.